Hello everyone, welcome to chapter 24 of CPI. In this chapter, we'll be discussing the details and intricacies of turtle soup entries. Now, I've already made a chapter about it, but that one only covered the basic and intermediate details. So in this particular chapter, we will be diving into the advanced and the more deeper intricacies and details of this topic. And by the end of this chapter, you'll not only be equipped with enough knowledge about how to get precise and accurate entries, right, somewhat similar to mine and Romeo, but also you would be capable of knowing how to properly integrate it with the other ICT and CRT concepts. We will discuss how to frame entries, how to put stop losses, and moreover, how to integrate it accurately. So without any further delay, let's get right into the video. So first of all, we'll start off with a bit of introduction to it. Now, some of you might already be familiar with this part, but let's remind it one more time so we are fully up to date on every single detail, right, including the basics. Because you know the basics are the foundation of any concept, right, and it lays down the base. That's why you should never take them for granted, but instead you should treat it with as much respect and importance as the other concepts. Because no matter how much you try to furnish or polish a building, if the base isn't strong, it will fall in a matter of time, right? It will be vulnerable, which is something you don't want. Now, someone could also argue that the base is even more stronger than the building itself, because without it, you know that the building cannot exist. So let's finally get into the details of turtle soup. Now, at its core, a turtle soup entry is an entry that focuses on the concept of a liquidity hunt or a liquidity purge, right? Now, you know what a liquidity hunt or liquidity purge is. It's basically when the market intentionally triggers the stop losses of retail traders, right? Which often breaches significant swing high or lows, and then after that we reverses in the opposite direction. That's what basically liquidity hunt is, right? We know that retail trader typically place their stop losses just above uh, highs or resistance or key levels, and below support level or key levels, or below lows, right? And we know that the smart money take advantage of this by pushing price above or below these zones, by rejecting above or below it to grab liquidity. And once the liquidity is hunted, grabbed, or manipulated, the market reverses and moves in the opposite direction, right? So basically, turtle soup entries allows you to join the move after the liquidity purge, which helps you position yourself on the right side of the market along with the market makers in the institutions, right? It's like following the steps of the institutional player instead of actually getting caught in their traps. That's what the point of turtle soup entries is. Now you might be wondering, why is turtle soup the most advanced entry method, right? Because this method requires a deep understanding of market behavior, liquidity zones, and timing, right? You need to be fairly and well equipped and well versed with all of these aspects, knowledge about all of these aspects about the market behavior, liquidity zones, and timing before you are able and you are capable enough to have precise and accurate entries consistently, right? Because turtle soup isn't just about spotting patterns, right? It's about understanding why the market behaves a certain way around key levels, and why is this liquidity being purged, right? You are anticipating manipulation and then capitalizing on the reversal, which require precise analysis, execution, and also at the same time some level of intuition and experience as well. Now let's talk about why is turtle soup so effective. So number one, it capitalizes on the retail mistakes, right? Now most retail traders relies on conventional setups like support, resistance, indicators, and trend lines, right? They place their stop loss in predictable areas, which become targets for institutional liquidity hunts, right? And turtle soup takes advantage of these mistakes by waiting for the liquidity purge to happen or the manipulation profile to happen before entering. Number two, it leverages institutional moves, right? Now, this turtle soup method or approach aligns with the institutional order flow, which helps putting you on the same side as the smart money, right? Instead of actually being manipulated by the liquidity grabs itself, you're using them to your advantage and ensuring you are trading with the prevailing market forces. Then last but not least, it gives you a clear risk reward structure, right? and it gives you a higher risk reward as compared to other methods and approaches, right? Turtle soup entries often come with a well-defined risk reward setup, right? Your stop loss is placed just beyond the liquidity purge at a protected zone, and your target is aligned with the next logical liquidity zone or mean reversion. And this clarity allows you to manage risk effectively while also maximizing your potential reward. Now moving on to the next slide. Here in this slide, let's start with what actually defines the turtle soup entry, and why it's one of the most precise and effective approaches and methods in ICD trading or CRT trading. We will cover both the content of the setup and the market context in which it occurs. So, what does a turtle soup entry look like? To recognize a turtle soup entry, you need to look for these distinct characteristics in price action, right? What happens is that price moves beyond a significant level briefly, right? The market pushes beyond a critical level such as a previous day's high, or a previous day's low, a candle range high, a candle range low, a swing high or a swing low, right? And this movement is designed to trigger stop losses of retail traders, which creates a liquidity purge. And then after grabbing the liquidity, price quickly reverses back into the previous range, and this reversal confirms the manipulation profile is completed, and it then signals the start of a move in the opposite direction or an expansion in the opposite direction. Now let's talk about the market context in which it occurs. Where and when does a turtle soup occur? That's the question. So to increase the probability of a success of a turtle soup entry, it must align with this. It must align with specific market condition and context, right? And it must align with a specific narrative. Number one, it should occur in the direction of the high time frame drawn liquidity, right? We know that turtle soup are most effective when they align with the high time frame liquidity draw. For example, if the high time frame drawn liquidity is higher, then you're going to look for a turtle soup entry where price manipulates below a candle range low, a swing low, or a previous day low, or whatever, before reversing higher. And if the drawn liquidity is lower, then you're going to look for price to reject above a high, above a candle range, or above a key level before reversing lower. Second, turtle soup should occur around higher time frame key levels, right? The probability of a turtle soup increases when they occur at a higher time frame key level or near higher time frame key level, and with that turtle soup they also test those higher time frame key level. They could either be in the form of a daily 4-hour highs and lows, order block breakers, or fair value gaps, right? And then last but not least, the most important aspect that you must consider and look for is that these turtle soup must happen at key times, right? We know that timing is critical for turtle soup entries, right? And some of the key times for turtle soup entries are the 3 a.m. macro, the 9 a.m. macro, 11 a.m. macro, and maybe during kill zones such as the London kill zone and New Year kill zone, right? These are key times at which turtle soup and manipulation profile happens. Now let's move on to the next slide. Here in this slide, we will talk about what aspects or factors makes a turtle soup high probability as compared to others. We'll also break it down into key factors such as high time frame drawn liquidity, sharp narrative, and the market context needed for these setups. Here are the high probability turtle soup key factors and metrics. Now, not all turtle soup are created equal, right? For a high probability turtle soup, you need a combination of precision, narrative, and alignment with the correct market dynamics, right? And let's explore what that looks like. First of all, we've got clear and defined drawn liquidity. The most critical factor for a high probability turtle soup is accurately identifying the high time frame drawn liquidity. You can only catch a high probability turtle soup if you know the direction that the market is aiming for. Number two, building a sharp narrative. Now, a sharp narrative ties together the high time frame context, intraday movements, and the market structure. And without narrative, your trade ideas are just guesswork, right? Um, And for building narrative, you'll use concepts such as weekly profiles, intraday profiles, the open high low close concept, power of three, dealing ranges, to build it, right? I've made chapters on all of these concepts, so refer back to those chapters if you aren't equipped with enough knowledge about it. A strong narrative gives you trade context and increases your confidence in your trade idea. It helps you anticipate why and when the turtle soup is likely to play out, right? And then number three, you have to make sure that your turtle soup entry aligns with the correct market context, right? Even with a clear drawn liquidity and a sharp narrative, you need to ensure your setup aligns with the correct market context. And the key elements that makes up a market context are key terms. You're going to focus on kill zone like the London kill zone, New York kill zone, when turtle soup are most likely to occur. You're going to focus on key levels, right? You're going to make sure that your entries are aligned with high time frame significant key levels like 4 hour order block, breaker, refugees, etc. And then you're going to use standard deviations, right? You're going to use standard deviation levels or zones to identify where price might be overstretched, right? Which will increase the likelihood of a reversal. And then you could use that standard deviation analysis in your own favor. And then last but not least, high time frame order flow. You're going to make sure your trade aligns with the prevailing high time frame order flow, right? You're going to see that whether price is rejecting above highs, rejecting below lows, and then you're going to use that to your own advantage by looking for rejection of highs in a bearish context or a rejection of lows in a bullish context, right? Now, the reason we make sure to do all of that is because proper market context ensures your setup isn't random, right? It increases the probability by aligning your trade idea with the broader market dynamics, right? And what you're going to do is you're going to make sure to connect the dots between the drawn liquidity, building a sharp narrative in the correct market context. And when all these elements align with each other, you have a precise high risk reward ratio setup that leverages institutional moves and avoid retail traps. Moving on to the next slide. Here in this slide, let's comprehend this concept of market context even more. Now, the reason why I'm explaining each one of these concepts in such detail is to make sure that you know how important they are, right? And not only that, but also to give it as much significance as I am giving it, right? And for you to become fully aware of it, because without it, you won't be able to have precise and good entries and executions. That's why these topics need and deserve as much time as the concepts itself, right? In fact, I could argue even more. Now, to make the most of turtle soup entries, you need a strong market context that aligns with the higher time frame structure, timing, and standard deviation zones. Number one, key levels. Now, the foundation of any turtle soup setup lies in the correct use of higher time frame key levels, right? And based on time frame alignment, you're going to choose key levels that matches with your trading time frame. For example, if you are an intraday trader, you're going to use daily or 4 hour key levels, and similarly for swing trading, you're going to focus on weekly or monthly key levels. Number two, key times, right? Now, timing is everything when it comes to spotting high probability turtle soup, right? And these setups are more effective when they align with each other logically at key times. Now, to use key times effectively, first of all, you're going to match key times to your own trading style, right? Your trading style in instrument determines the best time to look for turtle soup entries. For example, as an intraday trader, you need to look for entries and kill zones and key macro within the trading day. If you are a scalper, then you need to look for entries within kill zones at key macros. And similarly, if you are a swing trader, then you need to look for entry at key days of the week and key weeks of the month and even key months of the year, right? That's how you're going to determine your key time based on your own trading style. Now, liquidity hunts and reversal tends to happen at specific times when institutional players are most active, which makes key times essential for the correct market context. And then number three, standard deviations, right? Standard deviations help quantify how far price has moved from its mean, and it basically highlights areas where turtle soup setups are most likely to form and occur and for reversal profiles to happen. And you know the best turtle soup occurs at 2 standard deviation, 2.5 and 4 standard deviation zones. Now let's move on to the next slide. And let's break down refined entries for turtle soup setups and how to apply the correct logic. Now, a common mistake in trading turtle soup setup is rushing into an entry as soon as a high or low is taken. But let's be real, that's not how you catch precise high probability trades, right? Instead, you need to apply logic, the correct integration, and adaptability to refine your entries even more. Let's break it down step by step here. Number one, you're going to make sure that you don't rush into any trade, right? You're going to make sure that the move ends. The first rule of refined entry is that don't randomly take an entry just because liquidity has been hunted or a high or low has been taken, right? And this is exactly where most traders screw up. They just see a random high or a random low, and when that high or low is taken, they take an entry immediately and straight away, which eventually leads them to their stop loss being hunted, and then price reverses on them, and then they wonder what happened, right? That's why you never rush into a starter soup entry, but instead you're going to let the move in, because after a liquidity hunt, the market often experiences momentum driven spikes that can easily take out early turtle soup entries and traders, right? So your job is to wait for the move to exhaust and end, and then for price to provide confirmation of a reversal into the prior range, and then look for an entry. And you're going to look for wicks or sharp rejection at key levels, right? Or maybe you could look for a market structure shift on the lower time frame that gives you a confirmation, and then you can take an entry after that. Now, to refine your data soup entries, you must combine key level standard deviations and key times in a logical way. For example, if the market takes out a daily low during the London kill zone and it aligns with a 2.5 standard deviation level of the Asian range, right? You're going to wait for a confirmation, and then you're going to enter, right? And the, all of these confluences together significantly increases your position. You'll see multiple example of this in a minute, so don't worry about that. And then last but not least, the most important part is adaptability. One of the most critical skills in refining turtle soup entries is adaptability, right? Because we know that every day is different, right? Some days liquidity hunts might align perfectly with key levels and standard deviations. Other days the market might create new scenarios where you need to adjust your framework, right? And you're going to use your chart time, your experience in backtesting data to understand how different elements interact in various conditions and different market conditions. And you got to make sure that you never force a trade idea if the setup does not meet your criteria, right? Because sometimes sitting out is the best decision. And to ensure you are entering with precision, you're going to follow the following logic based checklist. First of all, liquidity hunt, you're going to wait for the high low to be taken in the move to exhaust. Number two, key levels and standard deviations. You're going to align your chosen key levels with standard deviation zones to create confluence. Number three, key times. Make sure that the setup occur at a key time, such as a kill zone or a key macro. And number four, confirmation. You're going to look for a rejection of wicks, shift in market structure, or lower time frame setups before entering. And then last but not least, adopt as needed, right? You're going to make sure that you are flexible and adjust to the day's unique condition and market conditions that are currently prevailing. Moving on, here in this slide, let's break down the logical approach to stop loss placement for turtle soup entries. Now, setting your stop loss for turtle soup entries isn't just about slapping it anywhere, right? A logical, structured approach not only protects your capital but also increases the precision of your trades and gives you a much more higher risk reward ratio and a much more favorable risk reward ratio as compared to other methods or approaches. Now, let's look at the multiple ways that you can use to place your stop loss and how to integrate them with each other for the best results. Now, ways to put your stop loss are the following. First of all, higher time frame key level. For example, let's say uh, there is a swing low, right? Just above a higher time frame discount key level. So what you're going to do is you're going to put your entry once the swing low is taken in the high time frame discount key level is tested, and then maybe you could put your stop loss below the high time frame key level. That could be either in the form of a order block or a fair value gap, or maybe a breaker block, right? That's one of the ways that you can put your stop loss, right? This method is a high probability method for putting your stop loss, but the one con of this approach is that it gives you a lower or unfavorable risk to reward ratio, right? So what you're going to do is you're going to consider this in mind and integrate it with the other ones that I'm about to discuss with you. Number two, lower time frame refined key levels. Another way of putting your stop loss is looking at the time frames on your execution time frame. For example, if you are taking entry on the 15-minute time frame, then you can look for 15-minute key levels such as order blocks, lows, highs, breaker block, fair value gaps, and you can put your entries on those refined lower time frame key levels. Number three, standard deviation levels. What you're going to do is you're going to calculate your standard deviation levels, the one standard deviation zone, the 2.5, or the 4 standard deviation zone, from means or ranges like the Asian range, manipulation legs, or CBDR, and then you're going to use these levels as logical stop loss points. Right now, I've already discussed this part with you in the standard deviation chapter, so if you haven't watched that one, make sure to watch that chapter first, so you're going to know exactly what I'm talking about. An example of this could be if price has purged a daily low and it has reached the 2.5 standard deviation of the Asian range and it has tested there, then you could put your stop loss beyond that standard deviation level, such as the 3 standard deviation level or the 4, and that would be a protected zone for your stop loss to be placed. uh, Next one we've got is order block stop loss. You can use the order block created during the liquidity hunt as your stop loss anchor, right? You're going to place your stop loss beyond the order block, which is going to ensure that it's within a logical structure. Then we've got swing points formed at key times. If a protected high or low forms during a key time such as kill zone or a key macro, then it's a reliable reference for your stop loss to be placed at. And then another important and popular approach is using fixed number of pips, right? You can set a stop loss of 10 to 15 pips above or below a key level, a swing point on an order block. Now obviously you cannot blindly trust this, that's why you need to make sure it's aligned with other protocols, right? And there is data to back it up. What you're going to do is you're going to collect data yourself, go through past historical data and see and put your stop loss, a fixed number of stop loss, either 10 pips or 15 or 20 pips, and you're going to see how does that data play out, and whether it gives you a favorable risk to reward ratio or not, or whether how much your win rate is, and then based on that you're going to select the one that suits your capabilities the best and your style the best. And I've seen successful traders use this protocol alone, but the thing is that you need to be able to collect data yourself and see whether it works on the instrument you are trading or not. And then last but not least, the approach that I use is the combination of these methods, right? The most effective stop loss placement often use 2 to 3 confluence from the above list, and then we're going to integrate and combine it with each other in a logical manner and then use that as our stop loss, right? For example, let's say we can combine the lower time frame refined key level protocol, the fixed number of pip protocol, and the standard deviation protocol. So what we're going to do is we're going to look for standard deviation level, combine it with a fixed number of pips, right? And then also match it with a refined lower time frame key level, and then we're going to put our stop loss there, and it will helps us have a even more logical and refined stop loss, right? You can play with it based on your own preferences and combine different protocols with each other. The best practice for stop loss placement is to take 2 to 3 confluences from the above list, right, and combine with each other to create a logical and reliable stop loss placement approach, right? And the way you're going to do that is by gathering data. You're going to backtest and collect data on different combination of stop loss methods, right? And you're going to analyze which setups consistently minimizes your risk and maximizes your reward, right? And then you're going to choose the method that suits your risk tolerance and your trading style, right? Now some traders might prefer stop losses with a tighter number of pips to get higher risk to reward ratio, while other traders might feel more comfortable with wider stops to allow trades to develop, right? And then it's you're going to decide that based on your own trading style, and you're going to evaluate that based on your own trading psychology. And then once you've identified the combination that works for you, you're going to stick to it consistently and follow it with discipline, right? Because consistency is the key to building confidence and achieving long-term success. Stop loss placement for turtle soup entries is all about precision and logic, and by integrating multiple confluences with each other, you protect yourself from unnecessary stop outs while allowing your trade uh, enough room to develop, right? And with practice and consistency, this approach will significantly improve your trading confidence and your overall performance as a trader in your results. Moving on to the next slide. Here in this slide, let me talk about something important that no one really talks about. So we're going to take a step back and get real about what it actually takes to succeed in trading, right? There's this obsession with snapper entries and catching extreme tops at bottoms, but let me tell you, you don't need that to be profitable, right? Let me explain. First of all, snapper entries aren't necessary, right? Many traders believe that they need to hit perfect entries every time, and they have to make sure that they get in at the exact top or bottom of a move to become successful. But that's not the truth. The truth is that profitable trading isn't just about perfection, right? It's about consistency. And I know that you cannot consistently replicate those snapper entries day in and day out, right? Maybe once a week or once a month you get those snapper entries, but the thing is that you're going to end up having multiple garbage trades in between, but that's not going to serve you any good, right? And the fact of the matter is that you need to find something that could consistently be replicated. If your entry is even just slightly off, but you have a solid edge in good risk management, you can still come out ahead, right? That's what it takes to actually succeed in trading, not snapper entries, right? And don't get caught up in the fantasy of nailing the absolute best entry, right? It's unnecessary, and honestly, it's impractical most of the time, right? You don't need to catch the extreme tops and bottoms, right? Let go of the idea that you must catch the extreme highs or lows to succeed. The markets are extremely messy, and trying to pick the exact reversal point will only lead to frustration and overtrading, right? What matter more is that you are entering with the market's momentum or structure in your favor. You are managing risk effectively so that even if your entry isn't perfect, your edge still plays out over time because you know how to manage your risk. Number three, focus on what you truly need, right? Instead of obsessing over perfect entries, shift your focus on what really drives success in trading, right? Which is a proven edge, right? Your edge is what gives you a statistical advantage over the market, whether it's a strategy like turtle soup or something else. A proven edge is what keeps you profitable over the long run, not snapper entries, right? You need to be aware of all the variables, right? You're going to make sure that you stay vigilant about all the key variables that influences your trades, which are market context, timing, key level, and risk management, right? And being aware of these factors help you make better decisions and helps you avoid unnecessary mistakes. The next thing that you're going to do is you're going to check your motivation, right? Here is an important question you need to ask yourself. Do you want to be profitable, or are you chasing snapper entries to impress others or feed your ego, right? If your goal is profitability, right, then remember this: all you truly need is an edge, right? You don't need flashy trades or perfect entries to succeed, right? Ego driven trading often leads to overcomplicating things, ignoring your rules, and ultimately leads you to losing all of your money, right? At the end of the day, trading success isn't about showing off or hitting the exact highs and lows. It's about building a process that works and sticking to it, right? And letting your edge play out over time in the long run, right? So make sure that keep it simple, stay disciplined, and remember that profitability is the real goal, right? Not perfection. So trust your edge, and the results will all follow. So remember this talk and remember this part of this chapter whenever you feel the urge to wanting to have precise and perfect entries, because honestly you don't need them and they are impractical. And what you need is a consistent approach that you can follow objectively and mechanically day in day out, that earns you profit over the long term, instead of having flashy setups and flashy execution that does not serve you any purpose in the long run. Moving on, here in this slide, I'm going to explain this step-by-step approach to you on how you can approach turtle soup entries. The first step is that start with a higher time frame. You're going to identify your drawn liquidity using the daily and the 4-hour time frame, because that's going to make sure that you are always on the right side of the market and you don't end up being the liquidity that the institutions are hunting. The second thing that you're going to do is you're going to build a narrative. You're going to determine how price is likely to move towards return liquidity, and to back that up you're going to identify which key level, which high time key level it might test before expanding towards the target, right? That's called building a narrative, right? And you're going to also consider when liquidity might be taken, meaning you're going to time all of this analysis and add the time factor into it. And then the third thing is that you're going to select key levels and candle ranges. You're going to select the relevant candle ranges and key levels that aligns with your high time frame drawn liquidity and aligns with the narrative that you've built. And you're going to draw out the standard deviations of potential mean ranges, right, like the Asian range or CBDR, and you're going to align them with your Tata Soup entries. Next thing you're going to do is you're going to wait for liquidity hunt or manipulation, right? You're going to look for these liquidity hunts or turtle soup at kill zones or key macro times of the day, and then you're going to refine your levels using standard deviations. You're going to match and integrate the standard deviations with key levels to refine them further for a more accurate turtle soup setup. And then last but not least, you're going to set your stop loss, right? You're going to follow your stop loss protocols that you've collected, and you're going to then also set the take profit level or the target level and let your entry play out. Moving on to the next slide, right here you can see this price action chart. We have this naked chart and we're going to use it as a case study, and we're going to see how we can have precise and accurate data soup entries, and we're going to use the concept that we discussed earlier. So let's move on to the next slide and let's annotate all the uh, relevant key levels on the chart to see what we are up to. Right here you can see that we are in a bearish order flow because we are rejecting above highs and breaking below lows, and that means our drawn liquidity is lower right here. What you can see right here is on the left, we've got this higher time frame. What you can see is we've got this high, and just above that high we have the fair value gap, which is our 4-hour higher time frame key level, and just below that high we have this 4-hour candle range, right? And that is a 4-hour candle range because it formed at a key time, right? So that is our CRT, and we're going to use that to frame entries on the lower time frame. And on the left we've got the lower time frame, and you can see the first one, that is the CBDR or the central bank dealers range, and then along with that we also have the second gray box, which is the Asian range, and these are basically the means. And what we're going to do is we're going to plot out the standard deviations of these means, and you can see that we have these different standard deviation levels, which aligns with the higher time frame candle range or CRT. You can see that the 2.5 in the 2 standard deviation zone of the CBDR aligns with that candle range high, and then for the Asian range we have the 2 and 2.5 standard deviation level which aligns with each other, align with the other standard deviation level. And you can see that by combining these key levels, these standard deviation zones, and the higher time frame context and narrative, you can see that we can take an entry right there at those standard deviation levels once price takes out the candle range, and then we can frame an entry there. Now let's move on to the next slide, and right here you can see that we took our entry at the combined zone of the 2.5 standard deviation level, which is just above the higher time frame candle range high, right? And for our stop loss, we put our stop loss at the 3 standard deviation level because we know that is a protected zone because price is already expanded enough to the 2.5 level, and it all happened at a key time. So more often than that, price is going to reject explosively off of there instead of moving above even more. And you can see we had a pretty good entry there. We framed an entry based on the higher time frame CRT, and that CRT was formed just below the higher time frame key level, the FVG and the high. And once that high was taken, the candle range was purged. We framed an entry there, and our entry was refined further to the standard deviation level of the Asian range in the CBDR, and the stop loss was placed by the standard deviation protocol, which is that we put it at the standard deviation 3 zone or level, and then we targeted the candle range low. That is our entry. Moving on to the next slide. Right here you can see that we've got another naked chart. Right here we've got this price section. On the right we've got the lower time frame price section, and on the left we've got the higher time frame price section. What we're going to do is we're going to plot out and annotate the relevant key levels, candle ranges, and standard deviation level, and then we're going to see how we would have framed our entry in this case. So right here you can see that our high time frame long liquidity is higher, right? And we've got this order block, higher time frame order block, and right there we also have this higher time frame candle range just above the order block, right? And on the lower time frame price section you can see that we have the Asian range, and also you can see this manipulation leg as well. With this manipulation leg we took out this high, so we can also use this manipulation leg to mark out other standard deviation levels as well, relevant standard deviation level where we could look for our entry setups or entries, Tata Soup entries. So you can see what price did is came down lower, took out the higher time frame candle range and tested the higher time frame key level, which in this case is the order block. And you can see also we had this mini turtle soup right here, and that turtle soup happened to perfectly align with the 2.5 standard deviation level of the manipulation leg, and also with the 3 standard deviation level of the Asian range. So what we would have done in this case is put our entry at the 2.5 standard deviation level, or after the turtle soup happened, right, on the lower time frame. And for entry we would have put our entry at the 3 standard deviation level of the manipulation leg. So let's see how we would have taken our entry. And right here you can see the entry was taken right after the turtle soup, and we took it right away because we didn't need to refine it further because it already matched with the standard deviation levels beforehand. So the only thing that was left is for us to place and put our stop loss, which happened to be at the standard deviation 3 level of the manipulation leg. And this is exactly how you're going to frame your entries, refine your entries, and place your stop loss based on standard deviations, key levels, and turtle soup entries. This is how you do it.